Inflation is more than a textbook concept or an occasional spike in prices. It is an economic force that reshapes society, governments, and individual lives. Its effects ripple across decades, often in ways that are subtle at first but profoundly disruptive in the long term. To understand inflation, we must delve into the systems and policies that have perpetuated it, often under the guise of progress or necessity. Take, for instance, the critical shift in 1971 when President Nixon severed the U.S. dollar's ties to gold. Before this, the dollar was underpinned by gold reserves, giving it a tangible value and a degree of accountability. With this backing removed, the dollar became a fiat currency, its worth determined by faith in the government and its central bank policies. For many at the time, particularly younger generations, the change went unnoticed. However, those who lived through the inflation of the 1970s remember the soaring prices, diminished purchasing power, and widespread economic insecurity that followed. What happened in 1971 was not just a change in monetary policy. It was the inception of a system designed to erode the value of money over time. This system, built on debt and inflation, is not an anomaly, but a carefully orchestrated strategy that continues to affect every corner of modern life. Inflation has long been a tool used by governments to extract wealth without directly raising taxes. By inflating the money supply, governments can devalue their debt obligations and fund spending without legislative approval. However, this comes at a steep cost to ordinary citizens, whose wages often fail to keep pace with rising prices. Consider the economic landscape of the 1970s. A single income could support a family of 4. While this didn't mean luxury, it did provide stability. Fast forward to today, and that same stability requires 2 incomes if it is achievable at all. Despite higher nominal wages, the purchasing power of the average worker has plummeted. Even households earning $150,000 a year qualified for stimulus checks during the COVID-19 pandemic, a glaring indicator of just how much the value of money has eroded. Nominal confusion, the illusion that higher numbers equate to greater wealth, masks the reality of inflation. In the 1970s, an annual income of $9,500 could support a family. Today, earning $58,000 feels inadequate for many. The difference lies in the hidden tax of inflation, which transfers wealth from the general population to governments and financial institutions. In the 1980s, globalization was hailed as the future of economic progress. By outsourcing production and integrating global supply chains, companies could reduce costs and boost profits. However, this came at the expense of local industries and workers. For decades, the public was told that globalization would lead to prosperity for all. In reality, it widened the gap between the wealthy and the rest of society. The COVID-19 pandemic exposed the fragility of these global systems. Supply chain disruptions led to shortages, driving up prices and exacerbating inflation. Meanwhile, corporations, having shifted their focus to global markets, prioritized profits over resilience. This fragility, a direct consequence of globalization, continues to fuel economic instability. Wall Street plays a pivotal role in perpetuating the current economic system. For decades, the public has been taught that the only viable investments are stocks, bonds, and mutual funds. These instruments, however, are deeply tied to the value of fiat currency. If the dollar loses its value, so do these investments. The illusion of wealth created by financial markets is underpinned by the same fragile system that generates inflation. Trillions of dollars exist only as numbers on a screen, backed by nothing more than the promise of future value. If the currency collapses, this wealth evaporates. The wealthy understand this dynamic and act accordingly. They diversify their portfolios, investing in tangible assets like gold, real estate, and collectibles. These assets retain value because they are not dependent on the fluctuating worth of fiat currency. One of the most telling indicators of systemic fragility is the behavior of the wealthy. Unlike the general population, they have access to resources and information that allow them to anticipate market shifts. Their actions selling off traditional financial assets and investing in hard assets speak volumes about their expectations for the future. In China, for example, wealthy investors have shifted from real estate to hard assets like gold and luxury items. This trend reflects a growing distrust in fiat currencies and traditional markets. Gold, in particular, remains a favored asset for preserving wealth. Unlike paper currency, gold has intrinsic value and a track record of stability spanning centuries. The manipulation of gold prices through Wall Street spot markets underscores the disparity between its paper and physical value. Financial institutions can create artificial gold supply through derivatives, suppressing its price while accumulating physical gold themselves. Those who understand gold's role as a store of value see through this manipulation, recognizing its true worth as a hedge against inflation. Cryptocurrencies have emerged as an alternative to traditional currencies, offering the promise of decentralization and privacy. However, their reliance on digital infrastructure makes them vulnerable to tracking and regulation. Opening a cryptocurrency account often requires personal information, compromising the anonymity that proponents value. While cryptocurrencies may appeal to those disillusioned with fiat currency, they lack the stability and privacy of physical assets like gold. Historically, gold and silver certificates provided a decentralized form of money, allowing individuals to redeem physical assets at will. This system ensured accountability as the withdrawal of gold from banks limited government spending. Cryptocurrencies, while innovative, do not offer the same tangible security. The transition from physical money to digital currency marks the culmination of a decades-long trend. While cash offers anonymity and independence, digital currencies promise convenience at the cost of privacy. Central bank digital currencies, CBDCs in particular, represent a significant shift in monetary policy. CBDCs are centralized by design, granting governments unprecedented control over individual finances. They enable real-time taxation, surveillance, and monetary manipulation, stripping away the financial freedom that cash provides. Unlike cash, which exists independently of the banking system, CBDCs tether users to a digital ledger where every transaction is recorded. The implications of this shift are profound. By adopting digital currencies, societies trade privacy for convenience, often without fully understanding the consequences. This transition mirrors the move from gold-backed money to fiat currency, a change that was also framed as progress, but ultimately eroded financial stability. History provides valuable lessons for navigating economic uncertainty. The patterns of the past are repeating, and those who fail to learn from them risk being left behind. Observing the actions of the wealthy can offer insights into effective strategies for preserving wealth. Investing in hard assets, reducing reliance on debt, and prioritizing financial education are crucial steps for individuals seeking stability. Gold, real estate, and other tangible assets offer a hedge against inflation and economic collapse. By diversifying their portfolios, individuals can mitigate the risks associated with fiat currency and financial markets. Understanding the design of the current monetary system is equally important. Complexity often deters scrutiny, but knowledge is a powerful tool. By recognizing the signs of systemic fragility, individuals can make informed decisions to protect their financial future. Inflation, globalization, and the rise of digital currency are forces that shape the modern economy. While they offer opportunities for growth and innovation, they also expose vulnerabilities that can devastate those unprepared for change. The wealthy, with their resources and foresight, act on these vulnerabilities by investing in hard assets and divesting from traditional markets. Their behavior underscores the fragility of the current system and highlights the importance of tangible assets in preserving wealth. For the average person, the path forward involves learning from history and adapting to the realities of an inflationary world. By understanding the mechanics of the monetary system and adopting strategies aligned with those who anticipate change, individuals can protect their wealth and navigate the uncertainties of the future. In the end, the choice is clear: learn from history or be swept away by its repetition. As inflation continues to erode the value of money and digital currencies threaten privacy, the decisions made today will determine financial stability tomorrow.